Well, thank you everybody for being here. I'm Paul Garofoli with the Standard. I'm not going to do a commercial for my company at all. I'm not going to talk about product, but I'm going to talk about something that I think is very important for you to know if you are in the insurance business at all. And that is the Department of Labor Fiduciary Standard. Now, I do fashion myself as the king of annuities. Self-appointed. I park my dragon in the parking lot. But for purposes of this presentation, happy graduation. I am now going to be the dean of the DOL Fiduciary Rule, the Retirement Security Rule as well. And we're going to talk about now how you all have matriculated to be fiduciaries. And by the way, I want to say hi to my audience worldwide from Annuity Fundamentals. So if you're a fundamentalist, welcome aboard here. So we're going to talk about the DOL Fiduciary Rule. You may have heard a little bit about it. Why it's important is that it is critical to know the rule, to know what you need to do to be a fiduciary, because it involves the source of funds. And we'll talk about what those sources of funds, but anything that is qualified, and I'll explain what that is in a little bit. So, what's going on? The Department of Labor has jurisdiction over retirement plans. Primarily, it was pension plans way back in the day, and then it evolved to 401ks, and then eventually to all kinds of qualified plans. And so one of the things that the Department of Labor was concerned about, and what the government is concerned about, is people's retirement savings. And so they feel an obligation to protect it in some way. Now, the environment that we're in, depending upon how you are licensed, depends on whether you're a fiduciary or not, up to this rule. So if people are securities licensed, is anyone security licensed in the room? You have a Series 6, Series 65. So we're insurance-only people here. So we're going to focus on the insurance-only element of it. But securities people, to a certain respect, are fiduciaries, but licensed-only insurance people are not. And so the Department of Labor wanted to address a couple different things, particularly rollover advice. What is rollover advice? Rollover from a 401k plan or a pension plan or a defined benefit plan to an annuity or even to life insurance. And because, depending upon how you are licensed, the Department of Labor in essence wanted to level the playing field. They wanted insurance-only people to have the same obligations to act as a fiduciary as somebody that is registered. So now it's a level playing field. You didn't have to take a class. You didn't have to go to school. You didn't have to take a test. You are now fiduciaries according to the Department of Labor, a government agency. So what's covered? All products that involve qualified money. That's qualified plans, participants, IRA owners, 401ks. And we'll talk about that because people say, well, what is qualified money? In the world that we live in, there's only two kinds of money, qualified and non-qualified. People go, what's qualified? What is that? And it's okay to answer that. Basically, qualified are accounts or funds that get some type of government benefit. That might be tax deferral, like in your 401k or your IRA, you get tax deferral. You don't get taxed on that every year. It might be a tax deduction or a tax credit. If you're starting an individual IRA, you get a deduction on your taxes, so you have that. And it can even be that you get tax-free income, much like you would do with a Roth IRA. So here's the list of what constitutes qualified money. IRAs, Roth IRAs, 403B plans, 457 plans, the thrift savings plan that many federal government employees participate in, defined benefit plans, money purchase plans. That is qualified money, qualified accounts. They might go, what's non-qualified? That's just money. Money in your bank, money under your mattress, money in your wallet, money in your purse. That's non-qualified money. You don't get any special benefit from the government on those kinds of things. There's three key terms I want you to remember from this presentation. One is the Retirement Security Rule. That's the actual name of this rule, the Fiduciary Standard as we refer to it in the industry, but it's the Retirement Security Rule. And people that have qualified accounts, remember an IRA, Roth IRA, 401k, 457, simple, SEP, any of these things, they are retirement investors. And guess what? From the regulation, you are now, as of September 23rd, 2024, an investment advice fiduciary. Congratulations. So you have that. So let's do an overview of the actual rule itself. Essentially, everybody that has an insurance license is subject to this rule, and it involves just about any type of account that has qualified money. We talked about that. You have to, and this is why it's important as an insurance-only person, when you're a fiduciary, what do you have to do? Well, in theory, you look after the best interest. We talked about that at the beginning of the session here, best interest of your clients. But it's not only a philosophy, it's a process. And what the issue is and why it's important to meet the requirements of the rule is that the government feels there's a conflict when you're dealing with people's retirement money. And that if you're getting paid to do that, whether it's a fee or a commission, there's a conflict. And in order to address those potential conflicts, and I know you're going to do the right thing all the time, but can you prove it? And can you document it? So you will hear about this term, a prohibited transaction exemption, or PTE, that in essence conflict of earning money, whether it's a commission on a whole life policy that we talked about, a commission on an annuity, if you're registered, a fee of some sort on assets under management. So these are the exemptions in order to receive compensation when you're giving advice or helping people. And that is PTE 2020-02. That's for registered representatives, people that are securities licensed in this room. We don't have any, but in the audience for Annuity Fundamentals, there will be people that are registered. The exemption that you will get is 2020-02. But for everybody in this room, if you're insurance-only licensed, again, you just graduated to be a fiduciary, it's 8424. That applies to independent life insurance agents, people that sell life insurance, annuities, and that sort. So what is the impact on what we're going to do? Once everybody's a fiduciary, there's going to be increased oversight on what you do. Many of you that have sold annuities, we talked about this, you know that you have to do a suitability review. You might say, Paul, doesn't my state have this best interest requirement or expanded suitability? Yes, but this is kind of best interest on steroids. It's kind of the next level there. So you're going to have new standards, new requirements, and we'll talk about what those are. Ultimately, not this year, but next year, your insurer of choice, where you place an annuity or even life insurance when it's funded from qualified funds, will have to approve your transaction. There's going to be new disclosure requirements as well. And in essence, what the Department of Labor wants to do is provide another layer of supervision, but I'm independent. I work with multiple companies. They still want the companies to have some type of oversight of what you do, similar to what's in the securities world. In the securities world, they have what's called an OSJ, Office of Supervisory Jurisdiction. There's another set of eyes looking on people if you're securities licensed. So that means you're going to have to adapt some sales and marketing practices, and that's why you're here, and I applaud why you're here. So now that we know the rule, what's the effective dates? And this is what's important. It's coming up, September 23rd. You thought graduation was in April or May or June. It's now for you in the insurance business. It is now September 23rd, 2024. If you're an agent or an advisor, you have to meet these two fundamental requirements. You have to acknowledge that you're a fiduciary, and you have to conduct yourself impartially. Impartial conduct code of standards of behavior. We'll talk about what those are. I'm not exempt. I work for an insurance carrier, the Standard. All the people that represent carriers, we are going to have an obligation, but we get a kind of a year to transition where we're going to ultimately have to supervise more closely the sale of our products respective to this requirement. And so we'll have to do both a review of your business coming in and a retrospective review of what you've done over the course of the year. So what the Department of Labor has done, as I said, is trying to make insurance companies more engaged. You probably know that insurance companies, hey, you do the business, they either say yes or no, but they're not really engaged in any extensive review. That is going to change. And not only that, and why it's important to me and to the company, our company will have to certify that we were watching our agents and helping them comply with the regulation and an actual report to the Department of Labor. Now, there are a few differences here, and again, for the audience here, insurance only, but we have an audience worldwide that is in the securities world. If you are a securities person, both you and your broker-dealer are going to be co-fiduciaries to this account. But here's the thing. For you, if you're an insurance-only person, it's up to you. You're basically self-policed. But what's interesting, the insurance company's not going to be a co-fiduciary, but they are going to certify that you acted as a fiduciary. So it's kind of a little bit of a mix there, but we have to make sure that you followed a process and, in essence, did the right thing. There are some core requirements on both of these exemptions to earn compensation. You have to act impartially. We'll talk about that. There are disclosures. I'm going to give you what the disclosure is. Policies and procedures that both the insurance company or broker-dealer and you have to adapt, record keeping, and the ability to self-correct. So we have those elements there. So here are the elements. This is the core of being a fiduciary. These 3 steps here. You have to provide advice that has a care obligation and a loyalty obligation. You can't exceed reasonable compensation, and you can't make misleading statements. You know, people say, what's a misleading statement? If you buy this annuity, you'll grow hair on your head. If you buy this annuity, you're going to lose weight. If you buy this whole life policy, you'll never be sick again. Those are misleading statements. Might happen, but we know that's misleading. And even more, that's kind of a fanciful way to express that. The real key here is a care obligation and a loyalty obligation. The care obligation is that you acted prudently, you did your best possible job in recommending either a life insurance policy or an annuity or other financial services products for other types of financial professionals, and went through a process. The loyalty is you put the client's interest first, regardless of compensation. You know, man, if I sell that product over here, I'm going to get 7, but this one's a little bit better, but it pays me less. Guess which one you have to sell? The one that does best by the client. So you put their interest first. And you might say, Paul, I'm leaving right now. I always put my client ahead of myself. That's my philosophy. I've lived by that. And I'm going to go prove it. Document it. Show me your folder. Show me your file. Show me your process. So again, it goes from philosophy to process when it comes to the sales of these products. The first step is you have to, when you're engaging in a client in a discussion, and you know that the potential source of funding will involve qualified accounts, 401ks, IRAs, Roth IRAs, SEPs, Simples, anything that's qualified, you have to give them a disclosure. Now, fortunately, the Department of Labor with the Retirement Security Rule actually gave us the disclosure template. I'm going to make investment recommendations. You might say, Paul, I'm not an investment person. Well, that's how they define when you're repurposing qualified money. Relative to the Employee Retirement Income Security Act, I'm not going to go word for word. The way I make money is I'm compensated for the sales of products, all right? We're letting them know up front. This is what it means to be a fiduciary. And under this rule, this is what we must do going forward at point of sale, going forward from that point, meet a professional standard of care. We talked about care. Put your financial interests ahead of my own. That's the loyalty requirement. Avoid misleading statements. Follow policies and procedures. Have a process. Charge you no more than's reasonable. Now, I think this is pretty easy. Anybody feel that they're getting paid unreasonably for the work that you do? I bet you feel you're underpaid. So I think we can agree that we're all getting reasonable compensation in that regard. And then really disclose if I have any conflicts of interest. You know, if you buy this product, I might qualify for some other incentive, things like that, or I might, get those kinds of additional perks that sometimes you can get if you focus on a particular product or a particular company. So let's talk about each of these tenets here. Now, you've given the notification when you're going to engage in somebody, and it's like you do your needs analysis, you do the profile, and you find out where money is. Oh, I better give them this disclosure, because I'm not talking about their bank account, I'm talking about money from a qualified account. So the requirement, and this is where we come in, we're going to have more oversight over your business with the respect to the particular carrier. So if you're going to represent or working with another carrier, not my business. When you represent my products, then I have to have that oversight obligation. So it's very narrow, but the challenge is all of you here work with multiple companies. Is that correct? So now, every company relative to their products may have a process, a procedure, an oversight relative to the sale of their respective products. We're also obligated to develop a process that we talked about, that we have oversight of what you do relative to the sale of our contracts. Record keeping. This is another requirement to being a fiduciary and meeting the obligation and having the ability to work with people and earn a living. Record keeping. You keep good records? No. Yes. So look at that. You're telling me yes. So keep good records. And that you have to keep it for 6 years. And whether you're a securities person or an insurance-only person, you have to keep those records for 6 years in a place, get a file cabinet, have a backup, electronic backup, all these kinds of things. So somebody may be calling on what you did 2 years ago, 3 years ago, that kind of thing. You do have the opportunity, if somehow you're found in violation of not being a fiduciary or not acting in that way, you can fix it. So, it's not one and done. Post-sale, there might be some things, additional things you have to disclose. So we have that. Now, I am not a fear monger, but I'm going to tell you, plain and simply, what happens if you don't or are not found to have acted in a fiduciary. You did not do care and loyalty. You made unreasonable statements. You got some crazy compensation. Those are fiduciary violations. Here's something fun, 15% excise tax on the transaction. I like to do math simply. If you did a $100,000 annuity, which is not beyond the pale, 15% is $15,000. You pay that because you were somehow found to be a fiduciary violator. You would also get a 10-year ban on working with qualified funds. So then it's only, hey, what's in your purse and your wallet, because I can't deal with your 401k or IRA. I'm banned, okay? Then likely, if somebody's found a product recommended, not suitable, not in their best interest, not up to a fiduciary standard, you're likely going to get a commission charge back, right? Because the insurance company's going to go, hey, we love you, but we're giving the money back. We don't want to get in trouble. So you have that. And then litigation exposure, again, not trying to scare you. And guess what? The enforcement mechanism really, I was going to say second now, it used to be everybody's hated federal agency, now maybe just second to the Secret Service, all right? And that's the IRS is going to enforce this because there's a tax penalty in terms of non-compliance. So that's important. So let's go over the dates again as we come to kind of the last few minutes of our talk here. So you're going to have 2 fundamental conditions that need to be met September 23rd, 2024. And that's the acknowledgement of fiduciary status in writing. We provided you with a copy of the disclosure. And most insurance carriers are going to make that available to you as we get closer to the implementation date. And then the impartial conduct standards, we'll review them again. This is the core tenets to being a fiduciary. The care obligation, you had a process. You were prudent in your analysis and recommendations. You were loyal to the client, putting their interests above your own. You have reasonable compensation. You didn't get anything excessive on that. And then you didn't engage in any material and misleading statements on what the product is. You disclose surrender charges, for example, with an annuity, those kinds of things. You do those 2 things on September 23rd, 2024, you're good. Happy day. Now, here's the secret. What the DOL is most concerned about is protecting people's 401ks and other defined benefit or contribution plans. That's the key. They write about it all the time. There's a bias in believing that many people might be better just staying in a 401k plan and not converting it to an IRA. We in our business, we go, oh, you got 401k money? I have a way to do some unique things with an annuity or even with life insurance to a certain extent. You might be better in there. So you have that. So they're really focused on rollover recommendations. What is a rollover? Essentially for us, 401k money into an annuity. 401k money into an annuity, and maybe also to life insurance in some form or fashion. I already told you it's the key focus. They write about it. That's all they talk about there. Now the good news is, in my opinion, now this is my opinion, if you go from qualified annuity to qualified annuity, your life doesn't change that much. If you go from IRA in the bank to IRA in an annuity, not much. But if you're dealing with the 401k or other defined benefit or contribution plans, you have more advice. And one of those things, I went over that too quick, one of those tenets is staying put. You might go, you know what? I love my annuity, I love my companies that I represent, but you might be better just staying put. So keep that in mind. That's a key element here. Now, what are the things you have to consider when you're doing this? And this is sometimes hard to grasp because it's like, well, I'm not registered. I can't talk about 401ks. You can't talk about the investment components in a 401k. You can talk about the nature of the plan. And those kinds of things are, what alternatives do you have within the plan? And I'll give you some other pointers here. What fees or expenses? That's different from giving investment advice. I'm not registered, but my uncle told me you should be in the international fund. I heard it's really good, but I'm not registered. Can't talk about that. But you might say, you know, you pay a fee on this 401k. The product or service I'm recommending does not have those elements. You might also consider whether the employer pays for the plan. Sometimes people actually pay a fee to be in a plan. And then what levels of fiduciary protection. So those four things are what are considered there. Now, practical advice. I'm an annuity person, so we're talking about that. You're life-centric, you'll have to consider the life advantages. What are things that you could consider in terms of why you might want to consider the rollover? Do you have an annuity option in your 401k? Most do not. Your 401k money, for the most part, is always at risk. There are very few safe money harbors within that. Does your 401k, Mr. Client, does it have an income plan? Does it have the ability to guarantee income? No, they told me if I take out 3 to 4%, there's a 90% probability it will last. That's not guaranteed. That's the annuity advantage that we have. Is there safe money or fixed account option? Very few plans have that. They all have all these great mutual fund-like sub-accounts. How about death benefit? Do you get an enhanced death benefit? That's where the life insurance comes in. There might be a higher obligation to leave on money than that. Do you have accelerated benefit options? Is there ability to take those funds and magnify them, leverage them, and get more monies for long-term care or home health care? Are there Roth conversion options? You know, a lot of people want to convert to a Roth and get tax-free payments out of that. And are there immediate market recovery options? That's a premium bonus. No premium bonuses in 401ks. Don't get that there. And then what is the impact of fees? You're paying a fee here. And that goes to one of my favorite things. This is actually in the regulation itself. Because a lot of people in the financial services world or financial critics criticize that we make commissions. But in the actual regulation, it says, for those people doing buy and hold type of strategies. Now, what product constitutes a buy and hold strategy, would you think? It begins with A, it ends with Y, it's what I sell. An annuity, it's a buy and hold strategy. So it might be better to get a commission there rather than keep paying a fee and you're not getting any ongoing service. So there is a place for commissions in our world. So what's the industry action plan as we come to a close? Notification. I'm giving you notice now. You're in the know now. You're in the 90th percentile because most of the other people are learning about how they could spend money to get some kind of prospecting system right now. You're getting education right now. Preparation, hopefully your preparation, regimentation. So we're trying to do as an industry, be consistent in what we deliver in terms of your requirements. And then my industry, the National Association for Fixed Annuities, on which I'm on the board of directors, we're actually suing the DOL, so there is litigation pending because we think it is an overreach to ask you to do things that's not normally in your purview. Is there a possibility of an injunction? Yes. Is the case strong? Yes. But we don't know. You know, think of all the trials we've had this year, and everybody thought that person's guilty or that person's innocent, and it went the other way. You never know when it comes to the courts. What's your action plan as we come to a close? Prepare, process, have your process. What is your process for analyzing things? Profile your client, plan, understand the types of plans that they have, the qualified plans, 401k plans, simple plans, SEPs, all those kinds of things. Do that plan analysis if it's a 401k. Of course, understand your products. You will likely get help from your distributors on these topics. And then post your recommendation in a file, in a place that's recoverable, documentable, and findable. Congratulations, everybody. You are now a fiduciary, and you actually took a course on how to be a fiduciary. So you're entitled to your designation, Fiduciary at Large. I'm Paul Garofoli with the Standard, talking also on behalf of Annuity Fundamentals, that you have this opportunity to be a fiduciary. I wish you the best. Enjoy the rest of your day. Thanks, everybody.